Ever wondered how money really works? Where it comes from? Or how banks seem to magically make a profit? It's a bit of a secret, but today, we're pulling back the curtain. First, let's talk about how banks make their money. It's simpler than you think. Banks essentially act as a middleman. They take money from savers, like you, and pay a small amount of interest on those deposits. Then, they lend that same money out to borrowers, like businesses or people buying homes, but at a higher interest rate. This difference between what they pay out and what they take in is called the interest rate spread, and it's their main source of income. Think of it like a store buying products wholesale and selling them at retail. The difference is their profit. This core profitability is measured by something called the net interest margin. While central banks, like the Federal Reserve or Bank of England, set benchmark rates, commercial banks have a lot of say in what you actually pay or earn. They balance their funding costs with how much people want to borrow, and even compete to attract stable deposits, sometimes offering better rates even if the central bank hasn't changed its policy. So, while central banks influence, commercial banks fine-tune based on the market. But that's not all. Banks also make a lot of money from fees, things like monthly account fees, credit card charges, or managing your investments. These fees are incredibly valuable to banks because they're a stable source of income, especially when the economy slows down and lending might decrease. It's why big banks offer so many different services. It makes them more resilient. Now for the real secret. Where does money actually come from? Most people think central banks just print it. But here's the mind-blowing truth. The majority of money in our economy is created by commercial banks, like yours, every time they make a loan. When a bank approves a mortgage or a business loan, they don't hand over a stack of existing cash. Instead, they simply credit the borrower's account with a new deposit. Poof! New money is created, often called fountain pen money. And when that loan is paid back, that money disappears. Central banks, on the other hand, create base money, the physical cash and the reserves commercial banks hold with them. They influence how much commercial banks lend by adjusting interest rates, making borrowing more or less attractive. They also act as a safety net, stepping in to provide funds if banks face a rush of withdrawals, preventing widespread panic. This shows a shift in how central banks manage the economy, moving from direct control to more subtle market influence. This system, called fractional reserve banking, allows banks to hold only a fraction of deposits and lend out the rest. It has powerful benefits and significant risks. On the one hand, it's a huge engine for economic growth. By freeing up capital, banks can issue loans for homes, cars, and business investments, stimulating activity that wouldn't be possible if they had to hold 100% of deposits. Without it, most consumers wouldn't have the means to afford modern necessities. But there's a flip side. Because banks lend out more money than they physically hold, the system is vulnerable to bank runs, where too many people try to withdraw their money at once, potentially leading to bank failures. Excessive lending can also cause the economy to overheat, leading to soaring demand and increased prices, contributing to inflation. The interconnectedness of banks means a crisis in one can quickly spread, threatening the entire financial system. Some even argue it exacerbates wealth inequality, as banks profit from interest charges that disproportionately affect lower-income individuals. This brings us to a fundamental concept. Money is, in essence, debt. As economist Paul Krugman put it, debt is one person's liability, but another person's asset. When you take out a loan, it's your debt, but it's an asset for the bank. This interconnectedness means that for our economy to grow, and for more money to be created, there must be more debt. It's a core part of how our modern system functions, challenging the idea that debt is always negative. Throughout history, powerful figures have commented on these very ideas. Henry Ford, the automobile pioneer, is famously quoted as saying, "It is well enough that people of the nation do not understand our banking and monetary system. For if they did, I believe there would be a revolution before tomorrow morning." This quote, while a paraphrase, captures his concern that the system's complexity and perceived opacity could lead to public unrest. He worried about sound money, currency that holds its value, in contrast to fluctuating paper money and the fantastic tricks which financiers play. The fact that commercial banks, not central banks, create most money through lending remains a surprise to many, highlighting the very lack of understanding Ford alluded to. Then there's Mayer Amschel Rothschild, founder of the banking dynasty, to whom the powerful statement is attributed, "Give me control of a nation's money, and I care not who makes her laws." This reflects the immense power that comes with controlling a nation's money supply. Central banks, through their control over interest rates and money supply, profoundly influence economic growth, inflation, and employment, shaping a nation's destiny perhaps more than its politicians. And Andrew Jackson, a U.S. president, famously declared, "I believe that banking institutions are more dangerous to our liberties than standing armies." This sentiment fueled his bank war against the Second Bank of the United States, which he saw as a greedy monopoly dominated by rich American and foreign interests. His fight and subsequent election victory showed widespread public distrust of centralized financial power. This historical struggle highlights the ongoing debate about the influence of financial institutions and the need for accountability. So, how does all this affect your daily life? Directly. The difference between what banks pay you for savings, like 0.57% on average in the US, and what they charge you for loans, like 21.16% for credit cards, is huge. This spread is a major profit engine for banks, especially from those carrying high-interest debt. It emphasizes why minimizing high-interest debt is crucial for your financial health. And speaking of debt, banks absolutely love keeping people in it. While some debt, like a mortgage, can be a strategic tool, consumer debt, especially credit card balances, can be a long-term profit center for banks. Studies show that for revolvers, those who carry balances month to month, an increase in credit limits often becomes an almost equivalent increase in debt, persisting for years. This cycle of dependence is highly lucrative for banks, making it vital for you to manage your debt strategically. Then there's inflation, the silent erosion of your money's purchasing power. When banks create too much money through lending, it can contribute to inflation, making everything more expensive. This effectively acts as a hidden tax on your savings, diminishing their value over time. Historically, the U.S. has seen an average inflation rate of about 2.55% over the last 20 years. This is why simply saving cash isn't enough. You need to invest your money in assets that can outpace inflation to protect your wealth. Also, be aware of conflicts of interest. Sometimes, a bank or advisor might have an incentive to sell you a product that benefits them more than it benefits you. For example, the recent UK car finance scandal revealed hidden commissions paid to dealers, leading to higher costs for consumers. Regulators try to prevent this, but your awareness is your best defense. The biggest secret of all? Knowledge is power. Understanding these financial mechanisms, how banks make money, how money is created, and the nature of debt, empowers you. Your credit score, for instance, is your financial reputation, influencing everything from loan rates to housing. By managing it well, you unlock better opportunities. So, take control. Budget wisely, tackle high-interest debt, and explore options like high-yield savings or certificates of deposit, CDs, to make your money work harder for you. To truly grow your wealth and combat inflation, consider diversifying your investments. Beyond just individual stocks or real estate, you can explore mutual funds and exchange-traded funds, ETFs. These are pooled investments managed by professionals, offering diversification across many companies or assets, which helps reduce risk. Diversification means spreading your money across different types of investments so that if one performs poorly, others might perform well, balancing out your overall portfolio. If you need help, consider a financial advisor for personalized, complex advice, or a robo-advisor for automated, low-cost investment management, especially if you're just starting out. The key is to find advice that aligns with your best interests. Stay informed, keep learning, and regularly check your financial health. When you understand the system, you're not just a participant. You become an active agent in shaping your own financial destiny, moving